Hi, and welcome to the third and last part of PMW 1, the first webinar of potential multi-baggers. And this time it is about your questions. Let's look at what we have already seen, the complete program of PMW 1. The first part was about the state of the market and portfolio management, and then a big announcement, the budding anchors. Of which the first one has been released today, DocuSign. And then in part two, we saw the potential multi-baggers one by one. And this time, the third part today is your questions. So this is all about you. This is all your content with the questions that you have sent me. But before we go into that, because there was quite a lot of volatility today, I had not planned this, but I just wanted to talk briefly about the state of the market. It won't be too long. You've got to put it into perspective. That's the first thing I want to say. Yes, I was down 5.33% in my portfolio as well today. But you should look at it from the long-term perspective. This is 1.95% loss in the last month. I mean, yeah, it feels like it was more because somewhere around the middle of October we were much higher. If you look at the last year, you see that this is 2 times the Nasdaq. You can see that it's up 38%. Well, give me a 38% return each year, please. So put it into perspective. This is completely normal. The markets don't always go up. They have to come down. They have to go down as well. Otherwise, you don't have a good market. Now, this is the potential multi-bagger portfolio picks of the last year. And as you can see, all are still, despite the fact that there was a lot of red today, except for Livongo, all the rest was red. But if you look at the last column, the return since I picked them in the last year, you see that all of them are actually up. Mercado Libre is not up that much, but that doesn't matter. It's only 2 months ago that I picked it. It will be a great stock in the long term, I'm pretty sure. So, but just look at the numbers: 48%, 462%, 3.7%. That's not that good, but okay. In the total, that that sometimes happens, Roku, 78%, C, 190%, Fastly, still up 47%, CrowdStrike, 26%, Paycom 27%, Mercado Libre 1%, as I said, and Cloudflare still up 33%. So look at it from a long-term perspective. Now, of course, you know that not everybody has added at that moment. Maybe you were not a part of potential multi-baggers yet. Don't worry. Or you just waited, or you didn't have the money at that moment. Don't worry. Look at Square, look at JD in part 1 and part 2 of the webinar. I talked about that. JD was an underperformer for 2 long years, Square for 18 months, so a year and a half. I mean, these things happen. If you are down on Fastly by, 40% or so, just don't panic. It's only when you sell that you really have a loss in your portfolio. Everybody would want to avoid the losses, but nobody can do that, so it's not possible. And you just have to accept it as a fact. And you should know that even if you're down, let's say 40% in Fastly now, don't worry too much. I mean, I'm pretty sure that if you will look back on this in let's say 2 years or so, that you will say, oh, yeah, well, that was a hard period. But look at it now, and that's often how it goes. It's a different feeling when you see a graph and when you are living through it. That's then you feel it. If you just look at it, it doesn't give you the same emotion as now. For example, if you're down 40% on Fastly, it really feels bad. It hurts, and you should know that it's actually normal. And especially potential multi-baggers, they go up a lot, and if they go up, they can go up really fast, but they can come down really fast as well. So don't worry. Just hold on to your shares. Selling is one of the most difficult things you can do. And there are lots and lots of people in the market who just base their opinion on the price. That's something you should avoid at every cost. I mean, it's not because the price is down that the stock is all of a sudden, or the company, because you buy a company, not just a paper, but you buy a company, and it's not because the stock goes down that the company doesn't do well. It was the same thing for me for Square. The market was down for a long time. I could average down because I had sold my shares of Square at $24, which I had bought at about 17 or so. I I didn't have enough conviction. I didn't know the company well enough, and that's when you start to doubt. Of course, um, it was one of my mistakes, which led me to the potential multi-baggers approach. But yeah, that's when I bought it back. I think I bought back for the first time at 83. I averaged up, and then it went to $100 or so, and then it went down and down, and then it traded into the 50s, and then the crash came in March, and it was at 32. I think I bought at I bought three times. Um, Normally, I just buy twice a month, but in such a crash, I can, yeah, activate faster, or I will activate faster because, well, it's sales, right? um, so, but I could bring down my cost basis of Square from, I don't remember exactly, was it 83 or was that the first buy? But it was somewhere in the high 80s, I think, or low 90s, maybe. I don't remember exactly. To 57, I think. So if you look at it now, it's a great stock, and it's even despite the big fall of today of Square, it's still a big winner. So you should always look at the long term. And yes, it feels bad to have a loser like, for example, Square, um, which didn't feel good. I mean, it's a year and a half. If you if you would count that to days, I mean that would maybe give you already an idea how many days you feel bad about that stock. But that's just the way you should. Um, well, you should look at your emotions and ignore them. Actually, you should know that you're playing tricks with me. I'm not giving in to you. I'm just holding. This company is still good. Yes, the price is down, and yes, that feels bad, and it hurts me, and it upsets me. But whatever. I'm still going to hold. I still believe in this company. The fundamentals stay the same. So the market can change any minute. You should know that. It can go up all of a sudden. It can come down all of a sudden. Yeah, well, if the elections are, of course, a big theme now. It has been for months actually, and everybody said, "Oh, the stock market is going to be volatile." Well, it has only become volatile. Yeah, well, in the last few weeks or so, or the last week even. Um, if you take volatility as going down, so what will it do next week? We don't know. We cannot know. I remember when Trump was elected, when the Brexit was there, the first reaction of the stock market was extremely negative. Stocks were down. I don't know how much, but a lot, more than today. And well, actually, if you would look at the graph, I think you would not even see it because um, the same day or the day after the elections and after the Brexit, um, stocks already took back a lot of their losses, and well, they still went down a bit, but I mean, it was quite moderate. Um, so you can never know what the stock market will do in general, and actually you shouldn't care that much. I mean, you're in the stock market to make money over the long run, and that's what you should keep in mind. So this doesn't matter if you have a bit of cash to deploy. Well, that's great for you. If not, well, just hold and you will do great as well. So just wanted to point that out because I know that it always hurts when the market drops so much, especially if you're not that experienced yet, or maybe if you have a lot of experience, but you're new to growth investing, for example, or you haven't trained yourself to not be a slave of your emotions, but to master your emotions. And that's always something that you should look at your own emotions and name them. What do I feel? Do I feel anger? Do I feel fear? So, and then, well, once you have named them, you can try to rationalize them. And I mean, I'm no robot. I think you all know that. It will be difficult. It will be difficult to mess it up. But if you have done that a few times, it will get better and better. Let's go to the questions. This is the first one. Hi, Chris. A portfolio management question. What's a guideline for percentage of my portfolio that should be in anchor stocks versus growth stocks? For your interest, I'm 20 years from retirement. Well, it depends. And I know that is not the easiest answer to get, but you should look at yourself. Who are you and how are you? Um, I can handle quite a lot of volatility, but at the same time, I want a bit of stability as well. So for me, I have written that in the Budding Anchor article. For me, it's about 50% potential multi-baggers, and then about 30% budding anchors, which are still quite volatile, and about 20% anchor stocks. Because the potential multi-baggers have done really well and haven't added that much to my anchor stocks. I'm at this moment, I think I'm about 17% in anchor stocks or so. But for you, that can be completely the other way around. So, how much volatility can you stomach? The more volatility you can stomach, the more potential multi-baggers, maybe. And I mean, don't do this because you think you can. You should have lived through March at least to know um, how you react in a real crash. So can you live with that, or do you start panicking? Um, it really depends on yourself and how much volatility can you stomach. That's what I said, and stomach. That's also what Peter Lynch says. The stomach is much more important in investing than the brain, and I actually agree. I mean, picking great stocks is quintessential to the process, of course, but no matter the fact that I put so much work in it, it's only the first part. The hardest part is for you. So, and that is holding on to those stocks through the volatility. Um, so, and that's important that you learn that and that you can do that. And once you're able to do that, you can take a bit more portfolio wise and a bit more potential multi-baggers into your portfolio, and then maybe at this moment you're still a dividend investor and you only add, I don't know, 10% of your portfolio in potential multi-baggers. That's fine too. I mean, everybody should know how they feel about their own portfolio. I have already said several times over that your portfolio should reflect your personality. So if you're a bit more conservative, don't try to be too aggressive in adding only potential multi-baggers. I mean, you will feel worse if you do that. You should listen to yourself. Now, also, it's finding your own balance. So there's no clear cut answer to this question, although it's a very interesting one to talk about. And you should think for yourself, how would your ideal allocation look like between the several categories: potential multi-baggers, budding anchor stocks, and anchor stocks, right? Second question: do you feel like you can realistically continue to find new potential multi-baggers at this pace with a conviction of 8 to 10, or at some point does it matter to be focused or concentrated on few high conviction stocks? No, I am. Well, of course, with budding anchors, I have already answered that a little bit. Now, do I think I can? Yes. Why? Statistically, I put a lot of work in it in my research. I put it's about 50 to 90 hours per potential multi-bagger pick. For the budding anchor now, it will be about, I don't know. I still have to finish the third part, so maybe I shouldn't say. But I think it will be around 70 hours again. So yeah, you can do that if you put that much work into it, and if you really want to know everything. That doesn't mean that I won't have losers. Of course, I will. But the more you know about a company, the more you feel how it actually is and what it will become. So knowledge is a real power. Now, a part of this question is also, are there enough stocks, quality stocks? And I want to talk about that. Now, this is the lifetime return of the Russell 3000 index. Stock total return minus the index total return. Now, what you see is that there are two extremes, 500% worse than the Russell 3000, and 6.1% of stocks dramatically outperform the index. Over their lifetime, they outperform the index by almost 500%, as you see on the total right. No, sorry, more than 500%, not almost, more than 500%, and that were almost 500 companies. That's what I should have said. So this is another graph that talks about the same thing. 25% of the stocks make that the stock market goes up. Only 25%. Yeah. So the best performing 25% account for all the gains. And there's 75% losers. This means that you should have absolute certainty of quality before you buy a stock. You should know that the odds are against you. 3 out of 4 stocks are bad stocks, or losers. That's why I always emphasize so much the quality of stock, and that's why I put in those long hours into my picks, because I know that quality matters so much, and this is quintessential. And I see too many investors looking at the candy of the day, and oh, this stock is doing great. Well, let's jump in. Yeah, okay, whatever, if it's a very small percentage of your portfolio, but too many people do that with a too big position. For example, I know that's a few multis hold this stock, so excuse me, maybe. Well, I hope you're not insulted, but Digital Turbine is such a stock, and I really like the management. I really like what they do. They are they doing great, and the stock has performed outstandingly. But I will not make it a potential multi-bagger as long as it is like now. Almost 80% of their revenue comes from four customers. Four. I mean, look at what happened to Fastly with TikTok. That was 12%. Digital Turbine's biggest client is 30%. Almost 30%. Well, somewhere in the high 20s. So I will not buy that. It's too risky. Could it be a great stock? Yeah, maybe, but not for me. I want more parameters that I can use to judge if it is a good stock or not. And if there are red flags, I'm saying no, sorry, not for me. Yeah. So next question. Chris, any guidelines around portfolio allocation would be of tremendous value. What percentage of your total portfolio should be in potential multi-baggers? What percentage in anchor stocks? So this is the same question, more or less. So make it reflect your own personality. What I wanted to say about this extra is there's much more, of course, than just potential multi-baggers and anchor stocks and budding anchors. If you want to have a REIT in your portfolio, you can. I mean, I won't do it because it's not my style of investing. But if you want it and you know something about you know you have someone who helps you, or you're good at your doing your own due diligence, why not? I mean, but again, there to go for quality. That's very important. What percentage allocation in a single stock would you think about rebalancing allocation, etc.? Yeah, so I used to put a hard number on this, and when I started out, it was I think 10% or so, and then it went up to 15. And at this moment, I say I don't see a ceiling. Actually, I mean, maybe 25%. I'm not sure, but I think it will. If it suppose that C Limited or another very high conviction stock would go to 25% of my portfolio, or even 30%, I would let it run. I think I could handle maybe 50% of my portfolio in. I wouldn't add, absolutely not. I would add all my money to other stocks in my portfolio, or new stocks or new positions, but I don't think I would cut it. But we'll come back to that later. In your weekly, monthly updates, if you can recommend, say, for example, you would recommend 2% allocation to JD for each potential multi-bagger based on your current conviction at that point in time, that would be great. Well, first, at that point in time, I don't time. So conviction is actually mostly stable. You see that I don't update the conviction ratings that much. I will after the earnings season has gone now. I will make an update. I'm not sure if I will give another, or give a company another conviction score. I'm not sure yet. Could be, but well, actually, I do that in my monthly portfolios. I allocate money as I would at that moment. Yeah. So, but it's tied to the hip with the yearly portfolio, and the yearly portfolio actually is how I see the ideal portfolio allocation. Yeah. So, if you want to know how I would allocate, that's where you find it. except for example, Cloudflare, which is a very recent position in the yearly portfolio, only a potential multi-bagger since last month. Well, well, I would want to build out that position. But in general, that's the yearly portfolio shows you how I feel about allocations. When you review the watch list or new ideas, are you starting off by only considering more established companies who have proven success? Meaning we may be too late to the 50x plus possibility, but we can be more confident in the possibility of a 10x as a result, and that's the strategy here. It's a good question. It's balancing. It's really balancing between those two extremes. The smaller a company is, the simpler it is to go 10x and beyond. But at the same time, the bigger a company already is, the higher the probability that you have good information and that you can judge the quality of the company. So um, there's a bigger chance that it will go 10x. So this is one of the things I was in doubt about myself a bit. I saw that I picked quite a few big companies in the potential multi-baggers because I believe in them. But I wanted to split up those two. So the potential multi-baggers from now on will be mostly 1 billion to 10 billion companies. So they have more potential indeed to maybe go 50x. Although I have to say 50x is really, well, a 10x is more something you can see at the horizon. A 50x is impossible to spot. So yeah, I think it's a balance between those two. Let's go on. Quite a long one. Exit strategies versus lifetime holdings. Your new username from growth to value implies that potential multi-baggers may be in industries where, if they execute well, could be lifetime holdings and eventually become anchor stocks when the growth story flattens out. Similar to, say, an Apple or a Microsoft that are paying dividends. And in short, have you thought about how to evaluate when the growth to value transition has occurred? What does the hall of fame of potential multi-baggers look like when it's finally time to say shop has 30x? Since we picked it, I will no longer recommend it in any monthly portfolios. Well, Shopify had, I don't know, I think 12x at the moment when I decided to put it back into the monthly portfolios. I thought there was too much, it was already too big. But one of the things that I like about the stock market is that by studying more and more about a company, you can learn more and more. There's no ceiling to what you can learn. And so I'm very aware of this. And the multi that wrote this question, very good question. Well, is correct that from growth to value implies that potential multi-baggers may become so big that they become actually maybe value stocks. I think I would remove them. I would let them in the portfolio as some sort of historic context, but I would not add them to the monthly portfolios anymore, and I would be very vocal about it. If I would think that they are not growing substantially anymore, I could even sell them, just as I did with a few losers in the portfolio, like Momo and Weibo, for example. I could sell them, even if it's Shopify. I mean, at this moment, Shopify still grows at a very high rate. So the last earnings yesterday, 96% revenue growth, which is amazing. So no way that I'm going to recommend selling Shopify right now. To the contrary, I have already mentioned this in overview of the week. There's one really important factor in how well a stock performs, and that is revenue. So I don't remember. It's the overview of the week article. It's called "It's the Revenue Growth Stupid," with a wink to Bill Clinton's "It's the economy stupid," of course. What you see here, and maybe you have already looked while I was talking, is revenue growth, revenue growth, revenue growth. So if you look at stocks, so sources for top quartile performers. So this is the 25% that we talked about that drives the market. If you look at what drives those stocks over 1 year, the multiple is the biggest contributor, 40%. But 32% already is the revenue growth. Now, if you look at 3 years, and you know that I always say that investing is for 3 years and more. If you look at 3 years, the revenue growth is already 48%. So the biggest contributor to the return of a stock. And the longer you hold, the higher that percentage becomes. Now, if you look at 10 years, then you see that the multiple is only contributing 1%. 1%. And the revenue, 71%. So I don't get it. If you are a real investor for the long term, I don't get it that you look at, oh, this stock is too expensive. Look at that multiple. Well, over the long term, it doesn't matter. Yeah, over a 1 year period, it could matter. There's about 40% chance that the multiple will go down. That's possible. Now, if you look at 3 years, there's only 15%. If you look at 5 years, 11%. And 10 years is 1%, right? So I disregard multiples. I look at revenue growth. And I look at the margins. And if you hold a stock for 10 years, the revenue growth and the margins together are almost 90% of the return. Yeah, 71 and 17 is 88. Yeah. So that's important to know. Next question. A question about selling stocks. Is there a system or a method, like you explained, about buying great stocks? Of course, the short answer is never sell. However, retirement, buying a house, marrying children are good reasons to take profits and selling stocks. How do we tackle this problem? Well, again, it depends. And it depends on the situation. It depends on your portfolio. Situation. Do you want a big sum all at once? Do you want a smaller sum? You want to buy, I don't know, a new car or so? Or for the cycling guy, a new bike, right? Yeah, Swift. Yeah, well, it depends on that. And it depends on who you are. Now, that's a general answer. I will go into a bit more granular details here. Suppose you have a loser in your portfolio. That would be the very first one that I would sell. Now, your conviction matters a lot. If you would want to sell everything, well, just sell it, right? But I suppose this question was meant, how do you do that? Now, suppose it's for retirement. It's for um, a house. Um, let's take those two. Retirement is actually quite simple, I think. You should look at the total of your portfolio divided by the number of years that you think you will need the money, and then, um, sell the amount of money that you need every month, every year. You can choose, and well, you do that in layers, right? I would prefer every month because then you average, you average, uh, not in buying but in selling then. So I think monthly is a good idea then. If you want to buy a house, I mean, that depends. If you have to sell your whole portfolio, you could try to market time a bit there. So saying this market is good, I'm going to sell my stocks. Um, if you want to play it safe, you could buy bonds, for example, 2 years ahead of the house buying. So before you buy the house, marrying children, I suppose that sum is a bit lower. I hope. Our child is just 6, so I don't know, but I think so. And then you could sell your losers and your lowest conviction, so you can make your own conviction score. Of course, you can landmine as a basis for your own conviction, but I'm sure that maybe there are stocks that I like a lot and you are not that convinced of. Maybe Fastly, maybe, I don't know, Mercado Libre or whatever. That's totally normal. You should have your own conviction, and it's always a great exercise to number them. Now, suppose you had to sell, which one would you sell first, and which one then, and so on until you say, and this one I would really keep this one. I mean, I think this is my golden ticket. For me, of course, with the 10 out of 10 conviction score, that would be C. So you can do that exercise for yourself. It's always very interesting to see your conviction and give it a conviction score as well. The majority of potential multi-baggers being in the tech sector, do you look at other sectors? For instance, there have been many potential multi-baggers in the restaurant sector, like Chipotle Mexican Grill. I know that currently tech is where the action is for stocks to move and become potential multi-baggers. But will that be the same in the future? And do you research other sectors and stocks? I will answer that question first. So, do you research other sectors and stocks? Yes, I do, of course, and you can see that in the watch list as well. There are stocks from several, or actually all sectors, I think. No, not all. I don't like energy. It's commodity. I don't like commoditized businesses. But yeah, I don't agree that there have been many potential multi-baggers in the restaurant sector. There have been many failures in the restaurant sector. It's a very risky sector. There have been a few potential there have been a few multi-baggers there, of course. But you can find multi-baggers in every industry. So yes, I do look at other sectors. Now, what I often do is I look actually at the scalability of something. A restaurant can be perfectly scalable, but it will be scalable at a slower rate than tech. So that's an advantage tech has. Now, the majority of the potential multi-baggers being in the tech sector, I actually don't agree. Now, I will look at the marketplace exclusive potential multi-baggers with you. So the same list as before. Now, Novocure, that's pure healthcare, right? No doubt about it. No tech. Livongo, yes, there's a little bit tech there, but mostly it's in healthcare. All right. Alteryx is tech, right? It's software. That's what I call tech. Roku is television. So yes, it has a tech component to it, but it's actually television, so communication sector. C, is that tech? I don't know. The biggest arm of C is retail, e-commerce. It's also in the gaming industry. It's also in fintech, so financial services. Well, it's already very difficult to attach a sector to it. Now, uh, while we're here, this is a great example of why I don't agree with the sectors. It's very artificial, and I don't look at it at all. I mean, it's really artificial, and yeah, you should diversify in the several sectors. No, that's often diversify. You don't have to have energy at all. You don't have to have commodities. You don't have to have yeah, something that you don't want to have. And especially not if you think that it's not future proof. So, again, see where will you put it in the traditional categories? It's impossible. The same for Amazon. Where will you put it? I mean, it has so many activities, it's almost impossible to do that. Fastly, sure, okay, that's tech. This is somewhere at the cross points of hardware and software. CrowdStrike, tech, yeah, I agree. Software. Paycom, no tech for me. This is services. This is service. Yes, of course, it's a cloud-based service, but that doesn't matter. I don't see this as tech. I mean, this is to handle a payroll a role. That's a service, not tech for me. Mercado Libre, again, where will you put it? Yeah, maybe retail, or Mercado Pago is already quite big, so we'll put it in financial services. It's another one, financial industry. I mean, I cannot see the financial industry as we know it now in, let's say, 25 years. I think a lot of banks will not go away, but become much, much, much smaller because they are being disrupted by these online platforms like Square, of course, and Adyen and PayPal, Venmo, and so many other Stripe. So and maybe Bitcoin in the future as well. So we'll have to see that. Then Cloudflare, okay, tech again, like Fastly, it's on the crossroads of hardware and software. Now, 4 out of 10, we saw four. We saw 10 stocks, and four were really tech in my eyes. So that is like the index. So if you take the S&P 500, 4 out of 10 is tech. I don't think this is exaggerated. So and at the same time, everything is tech, right? So even if you look at well, let's go to the next one, restaurants. I think the future will be much more at home, not just because of coronavirus. We already saw that coming. Because I was a teacher, I am in contact with young people, 16, 17, 18 years old, all of the time. So, well, they are not like our generation that they go out eating that much, or casual dining, or casual restaurants. I mean, fast food or so. They prefer going to get a salad at the supermarket than eating it together in the park or so. So I don't think restaurant business will stay as the same as it is, and yeah, I think there too there will be a tech component, be it like a tattooed chef, for example, has now direct to consumer selling, which is, well, maybe actually a bit like yeah, one of the services. Then it's so everything is mingled and mixed, and I don't think you should look at the sectors as in the old days anymore. I think this is completely new, and yeah, of course, people will want to put a tag on it, but no, there's no reason to. All right, a long question again. How to strike a balance between buy and hold forever and a fairly concentrated around 20-ish portfolio? Ideally, I'd like to buy and hold on to great companies, also known as potential multi-baggers or wink, for at least 5 years. I'd even like to have the option of adding to them along the way, assuming there will be a new potential multi-bagger every month. In 5 years, we'll have around 60 of them. And that's on top of the current 15-ish potential multi-baggers. How will you go about managing a 75 stock portfolio? Keep up to date on the latest and greatest news on each, adding to existing ones while starting new positions, etc. Looks like a full-time job to me. I can understand that question. Oh, no, it goes on. I almost forgot. I'd like to stick with 15 to 20 stocks, but that inevitably means closing many of those 60 positions along the way. So, how do you think about this whole thing? Good question. I'm not afraid of having 75 stocks. Now, if you look at 75 stocks, that means that the average position is 1.33%. 1.33%, which is small, right? That means that you don't have to really follow that stock closely. If a position is that small, just let it be. Yeah. If it would be a great performer and it was, let's say, 1% of your portfolio and it grows to 5% or even to 3%, that's a four bagger already. Well, yeah, sure. Then you should look at it and look at, should I add to that position? So of those 75, 15 to 20 will be substantial positions that you monitor. So it's actually more or less the same thing. If you have 75 stocks in your portfolio, just monitor the 15 to 20 biggest positions closely. The others you read now and then, the earnings, the titles, etc., and that's more than enough. Yeah. So don't worry about having too much or too many stocks in your portfolio. A lot of people are afraid of that. You shouldn't. You shouldn't. And it's perfectly okay to not follow them all closely. Next question. When you add a company to the potential multi-baggers, is it because you see a potential for 10x in a decade? It is, sorry. It is because you see a potential for 10x in a decade, more or less. Does this also apply to the current share price when you add to your positions monthly? Like if you still add to shop, is it because you still believe they could 10x, or how would you describe that? Well, that's a good question, actually. And I think I have not been clear enough there. So that would also mean that this question will lead to a change in the monthly portfolios. And from now on, I will add an extra column just after the stock, in which I will write how I consider this stock. So is it a potential multi-bagger right now at this price? Is it a budding anchor at this price, or is it a potential multi-bagger at this price? Yeah. So do I think Shopify, I think it's an example, do I think Shopify can still go 10x? Yes, I think so. Will it be in the next decade? Maybe, maybe not. It's hard to say. So because of that, that's why I would say at this moment it's more of a budding anchor because it's already so big. But yeah, it still has the possibility. And of course, I think I have already said that the bigger a company becomes, the more stable it becomes. There are a few exceptions, maybe, but I don't think Shopify will be the exception. So yeah, that's a very good question, and that's also something that will make me do an extra, will make me change the potential multi-baggers monthly portfolios. So thank you. Chris, I bought Novacure under 70. It's almost doubled for me. When a stock becomes twice or two times and becoming large in your portfolio, what will you do? Trim it or just hold? Well, first and for all, what a great problem to have. Congratulations. Well done. Novacure is a great stock. Now, if a stock, and you will see that there will be other questions like this. If a stock goes up a lot, I mean, there have been quite a lot of potential multi-baggers which have gone up a lot. Let's think of Livongo or C, for example. I'm not selling at all. It has become a large position in your portfolio. That could be of several reasons, because you have added a lot of money to it, and it was more than 10% of your portfolio already from the start. Or maybe you're just starting out, and that's why you have a big position in Novacure. For me personally, that's my opinion, both are not reasons to trim. For me personally, that would be a reason not to add to the stock anymore if it becomes maybe 15% or so, but I would let it run, especially Novacure. It's a great company. And if you look at the pipeline, I mean, there's more great news to come, and I could see it go 10x at this point, even if it really works out. So, yeah, I mean, I wouldn't trim at all. I would just hold and let it run. So, next question. My question is about already very successful potential multi-bags like Roku or Square. I bought both early in 2019. What is your advice to investors here? To top up with regular monthly saving plans with fractional share purchases, or to specifically wait for price weaknesses and then strike? Again, it depends a bit. How big are the positions already in your portfolio? Do you want them to become bigger? Why not add? I mean, I never wait for a price to fall. Very often, just look at Square now, for example. It has gone down a bit. Yes, that's true. But I mean, it's up from 32 in March. So mostly the price weaknesses or the price drops are still above the previous moment that you thought, well, shouldn't I add here? I mean, it's so fickle. The market is fickle, and you cannot know. So I don't wait. I just buy. I buy no matter what the price, unless I've got a feeling, oh, this is becoming really, really, really frothy, which is exceptional. So no, I don't wait. I never wait. Again, price doesn't matter that much. We have seen revenue. That's important, and price weakness has to do with the multiples. They don't care. They don't matter that much over the long term, so you shouldn't care too much too. Next question. What do you think is the ideal number of stocks to have in a portfolio? Also, how? Well, I will answer that question first. As many as you want, as long as it is great quality. Yeah, we saw that almost 500 stocks outperform 500 of 3,000 outperformed by more than 500, the index by more than 500%. Well, I mean, it's a myth that you cannot that a portfolio of 75 stocks or whatever cannot beat the market. It's just quality that matters. When you start to add stocks that are just a bit less qualitative, yeah, that's when you could get into trouble. But yeah, again, ideal number, no ideal number. Let's say I think at least 15 is quite a good number. I mean, to be diversified a bit. Um, so I do have a minimum. If you're starting out, it's normal that you don't have 15 yet, but try to start diversifying and yeah, try to get to 15 as soon as possible. 15 to 20 is, I think, a minimum. And everything above, as long as you still have a very high conviction, sure. Also, how should I think about the weighting of each stock? Say a 100K portfolio with 20 stocks. Should each stock be 5K invested with equal weight? Now, I don't think so. Should I give more weight to the stocks I have more conviction in? Yes, that's what you should do. If I were to give more weight to some stocks, should I have a rule to never exceed a limit like 10%? Yes, you could do that. Again, it depends on how old your portfolio is. In the beginning, it's okay to have more than 10% in any given stock. But if I say never exceed a limit like 10%, I mean the original allocation. So I never allocate more than 10% in my portfolio um, to a certain stock, but that doesn't mean that it cannot grow bigger. Mostly I stay at around 7-8% max initial allocation, and that's already a quite high conviction stock then. But if it grows higher, as I have said, I could let it run, yeah, to 50% maybe or so. So yeah, original allocation, yes, I should say, or I would say, yeah, take a rule there, the one that suits you the best. Next question. Sometimes I get excited about a stock and want to invest a lot to get better and or to get more returns. But now I think this is the wrong approach. I think it's better to have a more even weight distribution across the investments. But then sometimes I feel like if a stock goes up a lot, why didn't I invest more? Well, we all have that. I mean, if you would know that beforehand, it would be very simple. Oh, this stock is going to go up. I'm going to put 100% of my money in that stock. But you don't know that, of course. So, yeah, it's a great problem that you describe here, and I like the openness of the question. I get excited about a stock. Yeah, I think a lot of us know that, especially if you're only starting out and you're only doing this for a few months or maybe a year or so. Yeah, it's more difficult to get your excitement under control, your emotions in general, because um, this is the exciting part, but there's also the depressing part when the stock falls. Yeah, you really have to um, be able to stomach volatility to become a successful investor. So that's very important. Um, Equal weighted, I don't think so. I think you should have a high conviction, but very important, build that conviction over time. It's not because you have a high conviction right now, especially if you're less experienced, um, your conviction is less developed, and so how can you protect yourself from that? Well, by what I always say, you should scale in into positions over months. And if you feel that you have difficulties controlling these feelings of excitement, well, just put on a regular scheme and, for example, invest each month, for example, the same amount of money, and you make pre-scheduled scheme of how you will buy for the rest of, I don't know, for the next 6 months or so. If you add money to your portfolio twice a month, well, you can plan that well as well. I don't do that because I have my feelings under control, but it's a great way to do it. I have seen people using it, and they are very successful investors. So I think that could be that could help you with your problem. Making a scheme of buys. Chris, a question regarding the budding anchor portfolio. How would you allocate capital across potential multi-baggers and budding anchor portfolio? For example, if you have 10K to invest, would you invest 9K in multi-baggers portfolio and 1K in budding anchors? Yeah, well, I have already answered this question. I think I still want to include it because I think it's very important. If you, and that's the reason why I included it. If you say it like this, would you invest 9K in multi-baggers portfolio and 1K in budding anchor portfolio? Well, probably you will be inclined to do this. So probably this reflects your personality already a bit. I would say, yeah, maybe it's not necessary to have anchor stocks as well. So if you say I'm perfectly fine with 90% in potential multi-bags and just 10% in bonding anchors, all right, great. So that's your own choice. You should know that you will have more volatility then, but if you can stomach that, why not? You wrote something interesting about trimming and rebalancing. Could you explain your negative experiences with Okta and Shop in more detail? Yeah, I have written that a few times already, indeed. What are my negative experiences with Okta and Shop? Well, actually, I trimmed them. I trimmed my positions, and those are my most expensive mistakes. If I hadn't done that, I would have a much bigger portfolio. And if I look at my losers, so for example, Momo and Weibo and C-Trip and Talent, all combined, they're not even. I'm not losing the same amount of money as just trimming Shopify. So yeah, well, those are expensive lessons, but you learn from it. I never trim anymore. I don't rebalance, as they call it. I'm perfectly fine with having some stocks having a much bigger position in my portfolio, especially because it's quality. Rebalancing, you do that for me. You do that because you're not sure about a certain company. Um, I mean, if you have a winner, just keep it. That's generally the truth. Of course, people or lots of investors don't look at quality, and then if you have a winner, well, yeah, sell it quickly because who knows, it can fall every moment, as we saw in the previous webinar, part two. Well, we saw that the traditional stocks like the oil stocks and Johnson & Johnson, etc., yeah, those can fall. So well, of course, potential multi-baggers can fall as well, but over the long run, potential multi-baggers will do better because they're high quality. And even, of course, I won't say that Johnson & Johnson is not quality, but yeah, I mean, the big returns have to come from timing, because we saw how, I mean, Johnson & Johnson the last 10 years was up. I don't remember exactly. Was it something like 60% or so? Um, in any way, it underperformed the market substantially, and yeah. So yeah, I have negative experiences trimming, and I don't rebalance. So now I just don't do it anymore unless I have the feeling that my position has become too big for my conviction. Yeah. Then I would still consider it. But with potential multi-baggers, yeah, you know my conviction ratings. Most are 8 to 10. So I don't consider to trim them. Hi, Chris. Just curious, out of the many potential multi-baggers or budding anchors out there, how do you select or determine which one to pick for a particular month? For example, stock price near your buy point, potential big catalyst upcoming, someone in this community recommended to you to look at, cover it, or is it something else? Well, I'll start backwards. Is it someone in the community? No. I do appreciate that some of you say, "Oh, have you checked this stock?" But I have a long process before I pick. And if I say long, I don't mean days or weeks, but months. Um, so that already answers the question a bit, I think. Stock price near my buy point? No, not at all, because I don't look at price when I pick stocks. Potential big catalyst upcoming? No, neither. So, but let's take DocuSign so I can explain a bit better. What I see in DocuSign has a great product line, which it has introduced in the last 2 years. Especially in the last year, it has really updated and fast and introduced new products, acquired a few companies, and brought their products into the DocuSign suite. So when I see that, and I know that this is just a start of a long-term trend, then I pick that stock. For Cloudflare, for example, or Fastly, it's the same thing. I see that edge computing will become reality, and that's why I pick those stocks. So those are a few examples. It's always about the long term. I don't look at short term events or price or whatever to pick. I look at long term trends, but I try to be early in that trend. So within the companies, so not just a general trend, but within the companies, I look when they are set up to become really big. So, for example, Roku. I picked Roku because I saw that the ad dollars was still in traditional TV, while the streaming hours, just 3% of ad revenue went to CTV, connected TV, uh, while the viewing hours were 26 or so percent or so. I don't remember exactly. Could have been 25 or 27, but it was something like that before the crisis. So yeah, then you know that the money will follow the eyes, and that's is that a catalyst? Yeah, long term catalyst maybe, but I don't look at short-term catalysts or so. No, not at all. So I watch the long-term trend, and I decide when I have enough confidence in that particular company is set to profit from a long-term trend. And yeah, I look at the quality of the company, of course, as I have said so many times, and then I pick it. All right. How do you approach price valuation? I know the approach here is less technical, but for example, on the watch list, what calculation goes into deciding 1, 2, or 3 stars for price conviction? Well, those are, for me, two different questions. Let's look at the first one. How do you approach price valuation? I know the approach here is less technical. Yeah, it's not technical at all. I don't look at price. What I do is I just buy. I just buy. So there's no price valuation at all. I have already said that several times. If you have a 10 bagger and the aim is to get those 10 baggers, it doesn't matter that much if you even 30% or so difference. I mean, now Shopify is a very good example, and maybe it's a bit strange to take that example, and maybe you think it's the outlier, and it is to a certain extent, but it has gone up more than 10 times, and that's why I take that example. It has done that, and that's why it's an outlier. It has done it in a very short time period, so only 3 years. But if you look at the long term, if you look at the next decade or so, and you have a 10 bagger, what does it matter? I mean, your entry price. If you, I recommended Shopify at $70.86, I think. Would you be very sad if you would have, um, I don't know, added at maybe 90%, which is $90, which is, well, I don't know, maybe 80%, 18% higher or so. I mean, it doesn't matter that much. Even the big fall of Fastly, 30%. Well, if you look back at it, and then the story unfolds as I think it will, well, that 30% will not even be visible on a graph. Just if you want to check this, just look at the long term graph of Amazon. I mean, it dropped by 90% in 2000. Now look at the price of Amazon now and try to spot that dramatic fall of 90% in 2000. You won't even see it anymore, or just barely. So price is not important. The second question: what calculation goes into deciding one, two, or three stars for price conviction in the watch list? Actually, that has to do with the um, the potential of the company to markets. And that may sound strange, but I mean, I have to, if I don't know the company that well, I will give it 1 star. If I know it a bit better, I can give it 2 stars. And 3 stars is, well, I think this is actually quite cheap compared to what it could become. So it's not really price itself. It's more everything that surrounds that. Yeah, I understand the confusion, of course. I understand that very well. But yeah, it's just one element in so many. And well, I think I will leave it there. But price conviction is not really price conviction, so maybe I should think of another term. Hi, Chris. A strategy question. Yeah, we love that. When you open a position on a stock, do you only start buying when you see the stock is a potential multi-bagger or a budding anchor, or at least an anchor type? Do you open a position when you see the stock looks promising to you, but not 100% sure yet? For example, some promising players in watch list. Of course, I'm assuming all these stocks have passed their IPO lockup periods. Sometimes I tend to buy or start positions, small dollars amount, for such stocks, but later I feel I opened too many such positions, and overall they could negatively impact my return since they are not uh, as fast growing at a fast growing stage yet. So I want to consult you on this issue. Great question. I do sometimes open very, very, very small positions just to track a stock. But I mean, that can be one share of $50 or so, a really small amount, mostly sub $100 if possible. I won't say, oh, I will buy a Mercado Libre or Amazon share to track it. I mean, that's already too big in my portfolio. I mean, not not that it's not a top position then, but I mean, yeah, I mean, you don't do that for tracking. So I wait until I'm 100% sure to take. I mean, even 5% of the allocation I would want eventually. So suppose I would want a $10,000 position. Yeah, I wouldn't even buy $500 to, if I'm not sure yet. I would buy 50 if possible. So that's how I look at it. So, and of course, yeah, if you do that too regularly, yeah, you have a lot of clutter in your portfolio. So I also clean up the clutter every now and then. which means that sometimes I buy a stock to track it, and I'm not interested anymore after I've studied. Well, I sell it again then. So those small, tiny positions, either they have to give me something um, of conviction at a certain moment because I studied them, or they are thrown out. Yeah, so that's how I look at it. And I try not to exaggerate with those tiny positions even. I see you buying a couple of times per month. I think you said you put money in the portfolio twice per month. That's correct. This or that stock. How do you decide which one to buy? You seem to not look at the price of the stock. That's correct. I look at the allocation. I look at um, how I want to build out my position. So it's not like I have a regular scheme, which I referred to previously, but I do have my. I know what I want from a certain position. I know how much money I want to. Yeah, I want to spend on that position. So that's what I'm buying. I'm not looking at price. So at this moment, for example, I will buy DocuSign on Tuesday. I also want to add to my Cloudflare position still. That will be maybe 2 weeks later then, and then the week or 2 weeks after that, I could add to my DocuSign position again, and then again to Cloudflare, and then I don't know, maybe to CrowdStrike once, and then again to Cloudflare. So that's how it goes. I mean, I don't look at the price. I look at the allocation that I want to have in my portfolio. I just need an opinion from you how to make yourself hold on to your winners and not sell when you see nice profits. It's always tempting to feel like selling when you are profitable, and suggestion or suggestions. I thought this was a great question. I think it also has to do with experience. The first time that you see, I mean, even 50%, you think you're rich, right? And you did so well. It's only with experience that you see, well, this is up 100%, oh, 200%, 300%, etc. You get better at it. So give it some time, and just think of what the stock could become. I mean, let's go back to the Novacure example. The multi that asked the question, it has gone up or it has doubled. Should I sell? No, of course not. Or trim? No, of course not. Why? Because Novacure still has a lot of potential in its pipeline. So why would you? Just try to imagine the potential that is still there, and try to imagine, whoa, this stock could really go 10x and not just up 50% or so. So I mean, if you have a super talent in your sporting team, I don't know, whatever sports you want, if you have a super talent, are you going to sell it very early on for just a bit of money, or are you going to wait until that super talent becomes a superstar? And that's actually how you should think of it. So if it's up 100%, it's a promise. It's yeah, it could mean great things, but it 100% is not great. It a really good stock could change your financial position completely. I know somebody who was a very early investor in Netflix. I don't remember, but it was shortly after the IPO, and he was just out of college, and well, he bought, I don't know, it was something like, was it $3,000 or so of Netflix shares with $3,000, and that would have been millions and millions now. But well, he thought, I'm taking my gains, and he sold. He sold after not doing bad. I mean, he was up maybe 70% or so, and he thought he was a hero. So that's what you should get. You could get that you have something life altering in your portfolio and you sell it. Yeah, that's what you should think of. Chris, could you please cover your methodology of holding potential multi-baggers versus trading in and out with market sentiment, technical indicators, etc.? Well, quite simple. I don't look at market sentiment, technical indicators, etc. I just hold, and I just look at if the long-term story is still intact for the potential multi-baggers. If so, well, that's great. I will hold or maybe even add if I don't have a full position yet. Now, a few questions left, company specific ones, I think just two or so. Do you have any concerns about C's lack of profitability? I understand they are still in growth mode, but I get worried they might be trying to do too much at once. Compared to other companies like Crowd, with 80% plus gross margins and improving profitability metrics, while in hyper growth mode as well, C has a very long way to go. Yeah, well, C is the Amazon, or follows the Amazon pattern, right? So Amazon is still the stock of, well, if you look at the FANG stocks, well, Amazon is the one that is investing the most still. And I think it's an outstanding stock. I can see that in C as well. I see that same entrepreneurship actually inside of the company, to try out new things. So I'm not worried at all for the lack of profitability. They're they actually have a competitive advantage in that sense that Lazada, for example, or Tokopedia, their competitors, well, they have to get funds from funding. Yeah, they have to get money from funding, while C has a very profitable business division in Garena. So what happens is that the money that C makes with Garena is pumped into Shopee, and well, Shopee is now the biggest one in almost all of East Asia. So it has overtaken its competitors. So no, I'm not worried at all. It can fund that growth from inside of the company, which is great to see. At the same time, I think just as with Mercado Pago, with Mercado Libre, I think that their fintech arm will become very important, and that they, could have the same footprint in Southeast Asia as Mercado Libre has in South America or Latin America. So no, I'm not worried at all. Gross margins are always specific to a certain industry as well. So yeah, CrowdStrike has 80% plus. Alteryx has traditionally around 90% even. But Amazon, for example, has much lower. But I mean, I don't think anyone has doubts that Amazon is one of the biggest and most profitable companies ever. So yeah, not worried at all. To the contrary, I would be worried if C would be profitable now. They should invest right now to grab as much market share as possible. I mean, this is still an emerging market, e-commerce in Southeast Asia, and well, it's land grab time at this point. So yeah, they should invest as much as they can. Am I not worried they might be trying too much at once? No, not at all. Again, take Amazon, what they did. They tried out a lot of things, and some failed. Yeah, remember the Fire phone? But that doesn't matter. I mean, if you try a lot of things, some will be very successful, and that's important. And I see also great leader capacities or capabilities in Forest Lee. That, I mean, this could be an Asian version of Jeff Bezos, and I don't say that lightly. So no, no, not at all worried. I would be worried if they would be profitable at this moment. Here's a question about the trade desk. I've shortened this one a bit. In an article today on Seeking Alpha, author Trevor Genwine wrote that the trade desk's total addressable market is divided by several parties in a digital advertising transaction. So the publisher, the SSP, the ad exchange, etc. Also, he pointed out Google and Facebook have their own DSPs, which has about 60% of the market. As long as Google and Facebook hold that much of the total addressable market, then less remains for the trade desk or anyone else. My point is, TAM is a misleading number in a lot of articles, since the trade desk does not really have access to the Google Facebook revenue unless something dramatically happens. Well, quite a lot of things there. First, the total addressable markets. I think this multi is referring to the figure that has been thrown out of $1 trillion in digital advertising at a certain moment, or advertising in general, and a huge part will be digital. Sure, and yeah, of course, that has to be divided between the different players. I mean, yeah, I mean, the Trade Desk is not a huge company as Google and Facebook. I mean, it's not a 1 trillion company. It's, I don't know exactly right now, somewhere in the mid 20s or so, 20 billion. So as long as Google and Facebook hold that much of the total addressable market, well, I think that will, as Jeff Green has said, I think that will crumble. I think the walled gardens will crumble. Yeah, I have seen yesterday that Joe Biden side has complained about Facebook, that their ads are not shown and they don't know why, and they have asked information and they don't get it, etc., etc. That's typically Facebook and Google. They don't give any information, as Jeff Green says. They get to grade their own homework, and yeah, Facebook and Google have their own DSP, which means that they will charge as much as they can without the customer having the feeling that they are getting ripped. So I think CTV, connected TV, could be the icebreaker there. It's a very strong market, and the Trade Desk was up 40% year over year in that really difficult quarter, the second quarter of this year, when the total revenue went down by 13%. Well, CTV was up 40%, and I think that CTV could potentially be the icebreaker for Google and Facebook over time. It will be one of the elements. Also, the lack of clarity for Google and Facebook is a disadvantage for them. I think if the strong point for Google and Facebook is that they have small and medium-sized businesses, and they don't care that much about, especially small businesses, don't care that much about insights that they can gather from their ads. But the bigger clients want their own insights and data. So I think this will eventually become something like Amazon versus Shopify, where you see that Amazon's size will start to work against it. And it's if you look at a certain product, you get 3 other products first before you have that branded product from, let's say, Johnson & Johnson, and companies don't like that at all. So that's one of the reasons I think that the Trade Desk will be on the right side of history in this case, and so Google and Facebook won't collapse. I don't think that, even if there's a regulatory headwind, they won't collapse at all, but they will slowly crumble, and their walled gardens, well, um, those bricks could be removed, and I think that will happen over time. So this is an extra graph about this. So at this moment, the actual ad spend is 14% premium, 86% non-premium. Non-premium is Facebook, YouTube, Instagram. So made by ordinary people like you and me. And the optimal allocation, says a study, is 29% only non-premium and 71 premium video. So advertisers know this, especially the big boys, and that's why I think more money will start to flow to premium. And yeah, that's a great advantage for, of course, both Roku and the Trade Desk. So that was an extra, some extra information about that. All right, this is the end of Potential Multibaggers, the first webinar. I hope you enjoyed it. And well, in the next quarter, we will do another one. See you then. Bye.